Welcome, everybody. So excited to have Patrick McQueen here again, my resident real estate attorney, and always so full of information. So, Patrick, thank you for joining today. We've got some really good questions, and one of which I'd just like to start off. You sent out an article recently. I'm on your distribution list. I love what you do, and I just love the education you bring to the community, and it just struck a chord. So I really want to talk about what you call subject to transactions. And I think we'll kind of define that because when I first read it, I was thinking subject to generally from a lending perspective means the purchase contract comes over and it might be subject to, maybe subject to the buyer selling their house, subject to whatever. But this is like a whole different type of subject to conversation. So one, welcome. And two, let's just dive into it. Why the title subject to?
Yeah, no, great questions, and I'm happy to answer them to the best I can. So when I'm talking about subject to in that e-blast that you were talking about, I'm talking about this sort of investment product or investment scheme. I don't want to call it scheme because it's not illegal, but it's out there. It's an investment tool that a lot of people are starting to use. I've seen it happen. I saw it happen probably 20 years ago when interest rates are a little bit higher. Then interest rates became so low that nobody wanted to do what I see as called a subject to. And now over the last 6 or 9 months, as interest rates have gone up just a little bit, people are doing these subject to sort of creative financing. So that's kind of what I'm getting at. So you're taking subject to the seller's existing mortgage loan. So Kelly, in a traditional purchase and sale where we have a seller and a buyer, the seller's mortgage loan gets paid off at close of escrow. Well, in a subject to type of transaction, which again are becoming a little bit more popular largely over the last 6 to 9 months, subject to means that the seller's mortgage actually is not getting paid off and the buyer is basically taking on the responsibility of paying the seller's mortgage. So the seller's mortgage actually stays in place. Buyer then becomes the paying party on those types of deals. And what the advantage for the seller is, maybe they were in a distressed situation, maybe they're in a situation where they couldn't continue to make their mortgage payments. Well, now they have someone making those mortgage payments, okay? So in a subject to transaction, the seller provides a deed to the property so that the buyer is now the buyer and now the owner of the property, but the property is still subject to that first mortgage loan in favor of the seller's original lender. And so we're starting to see this stuff pop up. We actually see companies who are doing this as their primary business model. And so I sent that e-blast just so that people understood kind of what's going on. I wanted to make sure agents understood that when they hear this, this is what we're really talking about. Now, I want to make something very, very clear. This is not an assumption, okay?
Right.
An assumption of a loan is much, much different. An assumption of the loan involves giving the lender's permission to do this and having a completely new borrower. In a subject to, you're actually not getting the lender's permission. In fact, you hope that the lender never finds out, right? And if the lender does find out, that is a big, big, big risk. And the risk is that the lender says, oh, no, we don't like what you just did. We're calling your loan due. And this whole thing is blown up. And so that's the primary risk that a buyer may have in this type of situation. And there's ways you can kind of dance around that and get around that. But that's a big risk for a buyer. The other risk for a buyer in taking a property subject to that seller's loan is that the seller eventually files bankruptcy and then the deal blows up again. So there's some money to be made if you're willing to enter into one of these transactions. It's a low entry to getting into these types of deals. There's no loan fees. There's no, that sort of thing. But there's a lot of risk and a lot of risk that people just don't understand.
Yeah, I've heard these called wraps. And so I think when we're talking to the real estate community, if you're identifying and you know this to be a wrap, that's what we're talking about right now. So let's kind of walk through it. Most deeds of trust have a due on sale clause. And once that deed gets recorded, which you're saying in this situation, the buyer has a deed recorded, is the seller completely releasing all ownership in this type of scenario, or are they doing something where they would still have ownership? So for example, like what if the buyer doesn't pay? Then what?
then the seller's really in trouble because it is and once you give a deed of your property to somebody, it's over, right? You don't own the property.
Right.
And so you better do the underwriting. And if you're a seller and you're willing to do this, you better do the underwriting on the buyer to make sure that they're qualified. The other part of this is most times what we'll do is we'll use, or the people want to use a qualified sort of intermediary escrow company to make those payments on behalf of the seller, from the buyer to the seller's account. But yeah, the buyer in those situations is taking on all of those responsibilities. Now, I want to make one thing also clear. So what we're doing here is, in addition to the taking on of the seller's mortgage, we're wrapping around the seller's mortgage with another loan, with another deed of trust, with a wrap mortgage. Okay, and so that wrap mortgage comes in and wraps around basically the equity in the property. And so, yes, you still got this obligation to the original lender, but now we've got this wrap mortgage that sort of identifies the parties. And let's say that I'm a seller and I have a 3.5% interest rate. Well, that wrap mortgage should be 5.5, should be 6%, so I can at least make a little bit of money on the difference in the interest rates. The other way these are done, so you can do what's called a wrap mortgage to cover the difference between what is owed to the original or to the primary lender and any balance that may be owed, to cover the purchase price. The other way you can do this, somebody does a straight subject to where they're paying cash for that difference. So I buy your house for $500,000, you owe $400,000. We can either do a wrap mortgage to cover that additional $100,000. I can pay cash for that additional $100,000. Or what some other people will do is there will be junior financing where I give you a note and you take on a secondary deed of trust against the property. And the deed of trust is my obligation, or is my security for my obligation to pay you that remaining amount. So there's a couple of ways you can handle it, one of which is the wrap mortgage, which is what is traditionally used.
Okay, my mind is like, right now I have so many
Sure.
thoughts. So first, let's just kind of chunk it down. If the buyer does this and let's just say that they're wrapping the seller's current mortgage. You alluded early on in this conversation, but if that seller happens to file bankruptcy and I, as the buyer, put down the $100,000 cash and my name's on the deed of trust, walk me through. The bank's going to foreclose because the bank's in lien holding position on a property that now I own. That just seems like so messy. What happens to my $100,000?
Probably gone. Yeah, it's probably gone. And so each of these parties really, really needs to have a lot of trust in the other, or this needs to be a super short-term type of thing, right? We're just doing this to flip it or fix and flip it or something like that. So you really, really have to have a lot of trust in that seller that that's not going to happen. There are ways you may be able to keep that deal together by refinancing it immediately or something like that, but you're going to be dragged into a bankruptcy if the seller files bankruptcy. There's no way you're getting out of that. There will be some sort of bankruptcy type of resolution with respect to that $100,000, because the seller may not be entitled to keep that $100,000 because that money needs to go to the seller's creditors. And so it has the potential to be a big mess. And so that's just one of the things that people, they don't even know. This sounds great. This is a great deal. I'm going to get in real fast and I'm going to make a quick buck and, take on a super low interest rate. But, one of the risks is that bankruptcy. We don't know necessarily what's going to happen in every single bankruptcy, but you'll be involved in it. That's for sure.
Right. And then from a seller's perspective, let's say the seller agrees to enter into this type of relationship, and then the buyer defaults. They literally have given the ownership by signing over the deed to this buyer. So now they're obligated on a mortgage note and they have no ownership interest in the property. Now what? How do you unravel that?
You just lost a lot.
You just lost your property and you're obligated on the note. How, without going to court, how? I don't even understand why. That just seems so risky.
It is. And, a lot of sellers in these types of situations are in a pretty difficult spot. They're in a desperate spot, and they're just kind of hoping and praying that this buyer will come in and sort of save their credit, continue making the payments the entire time, and eventually get out of this deal. And so it is extremely risky for both sides. You're absolutely right. Because if that buyer files bankruptcy themselves, or if they just stop paying, you lost your house, and you're not getting that back. And now your credit is shot, which is something you tried to avoid in the first place.
Yeah. Let's walk through title insurance. So you mentioned earlier that you would suggest maybe using a third party to ensure that the payments are getting paid to the seller's lender. Is there title insurance involved on this type of thing? So now the buyer understands, what liens are against the property, and is this an insured type of instrument or not?
So there are some title companies out there who will underwrite this type of deal, but they're kind of far and few between. So some title companies just say, we're not willing to take on this risk that this lender calls this loan due. And so it is extremely risky for title companies to engage in these types of deals. And so some of them just say, don't even ask us to do a subject to, don't even ask us to do a wrap. We're not doing it. We'll do traditional seller carry financing. That's not a huge deal, but don't involve us in some wrap. We're not gonna underwrite it. We're not gonna insure it. And so you really have to find the right title company. And some of them just will say, no, we're not touching it.
Yeah. And I've heard that from a title company perspective that they're really focused too on the type of loan that's in place. So if it's a government-backed loan, like I think that's a very, very big risk for a title company. And I've heard that they won't even touch it. If it's a conventional loan, those that are doing wraps, they're probably looking to identify that it's a conventional loan. But nevertheless, I mean, again, title insurance is one of those things that it's kind of like the unknown protection when you're acquiring a property. As a buyer, I would want to have title insurance so I really understood what's going on with that particular property that I'm buying. I mean, you don't know what's out there from a lien perspective and then once then the title insurance is just protecting you if things come up in the future, that were maybe missed. So I think seems like it's risky on all parts. So you're saying that the real key here is, the companies that are doing this as their business model, they're looking for people that are desperate to sell. And the upside for the buyer of these companies that are doing this is they don't have to use traditional financing. They might be able to do zero down. They come in and probably take over a fairly low interest rate. So from that perspective, there's the positive. So from the buyer's standpoint, other than not being able to have it insured from a title perspective, their only risk truly is if the seller files bankruptcy. Outside of that, they now own the property.
Well, the other risk is that the lender calls the loan due. Let's step back a second, because you were mentioning title insurance and looking at title reports. That's something you have to do before the deal closes. You absolutely need to make sure that you can get title insurance, right? And you need to take a look at what you're inheriting. You may be inheriting a bunch of government liens. You may be inheriting IRS, medical liens, whatever it is. You're inheriting all of that. So, again, there's a lot of due diligence that a buyer needs to take on before they even consider this. But you're right. That's one of the things that needs to be looked into before you enter in one of these deals, for sure.
Yeah, absolutely. So I'm just struggling from it seems scary to do. It seems very risky. And I think that but it's happening. And we see as markets go through cycles, this isn't the first time this has become a popular topic. And back in the day, it was much more used than I'm hearing now, because I think that probably people are a little more aware of it. And back in the day, title companies were more willing to insure these types of transactions and do wraps. I think now it's like a different, scrutiny from the players out there, the agencies and the title insurance regulators. So let's walk through a lender finds out. Now, lenders, it is important to know that they do deed searches. They're looking for this type of stuff, especially in this type of environment. So I think it's naive to think that, they'll never find out. I mean, I don't know what the stats are. I don't know what the statistics really look like. But if the lender finds out, then they're going to go back to the seller, call the note due and payable, And now as the buyer, they own the house and they just have to give it back?
Well, they could try to get a refinance to pay it off and get rid of it.
But
And
if they did this type of deal, they're probably not in a position to refinance, I would guess.
it largely defeats the whole purpose of one of these deals. I mean, it really does. So if the lender does call it due, if the lender calls the note due, what usually happens is the lender will send some sort of notice of default or some sort of notice, and the borrower will then have 30 days to fix it, right? And so you start scrambling at that point, like, oh my gosh, what do we do here? We have got 30 days. Otherwise, this lender is going to start the foreclosure process because that's their next natural remedy. Well, guess what? We tried to avoid all of this. We tried not to have those type. We engaged in this type of transaction because we didn't think that this would ever happen to us, and so now you're left scrambling and you just lost the deal pretty much. I mean, you lost your investment. You're going to be scrambling to get some sort of financing when that wasn't what you ever intended to do, and so there is risk there, and that's what people don't understand. So the bankruptcy risk is real. The lender calling the note due is real as well. And so what some people have done, there's some kind of advanced sort of techniques out there. What some people will do is they'll convey the property to a trust, and the beneficial interest in the trust is owned by this new buyer. And so there's some ways to try to pull a head fake on the lender and that sort of stuff. So people are dancing around this thing and trying to get around it, but it's dangerous. It has risk. It's not a perfect system. It's not a perfect scenario. There's risk, and that's just what people don't understand. And usually in a period like this, we start seeing the results of people taking on too much risk, and these deals fall apart and become just a complete mess. And so people are left. Somebody's left holding the bag. I just spent $100,000 doing this. I spent $200,000 as a down payment, and now I lost it. And so you really, really, really have to understand the risk. You really, really have to have good documents. You really, really have to trust the other party. And you really have to hope that the lender doesn't catch on.
That's a lot of hoping and praying, like, let's just keep our fingers crossed.
Yeah.
You like that's a great strategy over the long haul. There's got to be a takeout at some point, I would think, is part of the strategy.
Well, I think that the strategy is usually, hey, let's do this for the short term. Let's see if we can put this property in better condition and do a fix and flip and try to make a little bit of money and hope that, if the lender does call it due, I've got plenty of time to still make this, flip happen or something like that. So to me, if you're going to do it, you have to understand the risk, and then you probably want to have a short time frame for doing something like this. So it works. It's not illegal. Nobody's going to jail for it, but you got to know what's going on.
Yeah. So I do want to reiterate that this is not an assumption. You mentioned that earlier, but that is not this. That's not what we're talking about. In an assumption situation, which we are starting to see a lot of conversation about that, obviously with rising interest rates, some sellers out there are holding notes that are 2 to 3%, which is very attractive. And so from an assumption standpoint, if a seller has a property and they want to put it on market with the possibility of an assumption, most loans that are assumable are going to be VA or FHA loans. Traditionally, conventional loans are not readily assumable. But if a buyer or a seller has, let's say, a VA home loan, and I just had this scenario, so we can talk to it. The rate was 2.25%, and the balance on the note was about $300,000. They were selling the house at $700,000. And so in that scenario, the buyer is coming in. They would go to the seller's lender. They would apply for the assumption, and they would have to come to the table with the difference between $700,000 and what's due on the note. So in this scenario, $300,000. So they were putting $400,000 down. Now that works as long as they can qualify for the assumption. And on VA, it's very tricky. I think a lot of people think that in the VA assumption scenario that the buyer has to be a veteran, and that's not necessarily the case. A buyer doesn't have to be the veteran. But here's the thing to know. In that scenario, the seller's benefits, their certificate of eligibility will still be encumbered as long as that debt, that mortgage is in place. So if the buyer defaults and they're not using VA home loan benefits, then it could permanently go against the seller's eligibility. And so in future use, it may limit what they can do in the future with regard to their VA home loan benefit. So I think that's really important to make sure people understand that. So there's a risk to the seller in that scenario. If the buyer does have VA home loan benefits, then the eligibility transfers over to the buyer, and it's a much cleaner type of scenario, releases the seller's full entitlement, and they can go out and use their eligibility again. But lots of these conversations, and I think sometimes I actually had a real estate agent call me because they just needed to know the facts. And, I'm like, well, did you contact the seller's lender? And they did, and they just couldn't get the straight scoop because, again, nobody's talked about assumptions for years. So it's back, right? It's back in a big way. And so now we just have to kind of re-educate ourselves on how it works, etc. So
Yeah. And to be clear, an assumption is so much different than subject to.
Yeah.
I mean, it is assumption. You get permission. You have the lender knows what's going on, and nobody's trying to pull a fast one here and hope that the lender doesn't catch on. The lender is caught on and provides permission.
They're involved. They're absolutely involved, and they're approving it. The buyer's going through a credit and income qualification. They're meeting the guidelines and all of that. All that's really happening is that responsibility, the note is now going over to the buyer, as is that low interest rate if that's what that current loan has. And so that's why assumptions are attractive right now.
Yeah, exactly.
Yeah. Well, Patrick, thank you so much for giving us your 2 cents on the subject to wrap type of scenario and all of the risks that it has. And Patrick, if people need to get a hold of you, I know you're in real estate, you're a real estate attorney, but tell us what is really your focus?
100% real estate. So all we do are residential deals. We help with people involved in a bad residential deal. Usually, we're not going to be involved in a good one. If everything goes smoothly, we're not involved. Or commercial deals, we'll get involved in negotiating leases, reviewing and negotiating purchase and sale agreements. We get into a lot of quiet title actions. Where people are disputing who owns land. Those are always fun. And the big thing right now are really short-term rentals. There's a lot of sort of new laws when it comes to short-term rentals. There's a lot of new statutes. And so we're really big on educating people on short-term rental issues right now. It just seems to be the topic of the day. But the new topic of the day is this sort of creative financing that we talked about, or not so creative financing, because it's really nothing new. I was telling my wife and my kids, I was like, they need to bring back everything from the 80s and 90s because the trend, everything kind of repeats itself, right?
It really does. Well, if you have questions, we've included your phone number and your email address. Feel free to reach out to Patrick. He's fantastic, and I'm sure he'll give you the guidance you need. Thanks, Patrick.
Thank you.